Welcome to Stock Market Today, your market briefing with actionable insights on stocks, bonds, crypto, and the events moving markets. Let's get into it. 5 days out from the Federal Reserve's March 17 to 18 FOMC meeting, and positioning is intensifying across every major asset class. The Fed has maintained its target rate at 3.50% to 3.75% through recent meetings. But economic data shifts are creating expectations for a dovish pivot that could trigger significant repricing in equities, bonds, and digital assets. Markets are pricing roughly 60% probability for a neutral hold with one rate cut signaled for 2026. But that 25% probability of a dovish hold showing two cuts is where the real trading opportunity sits. Let's start with what's driving this setup. Consumer Price Index data currently sits at approximately 2.4%, showing continued progress toward the Fed's 2% target. That disinflation trend is critical. It gives policymakers room to ease without fighting active inflation pressures. According to research from FOMC, if the Fed shifts its dot plot to indicate two cuts instead of one while holding rates steady, crypto markets could rally 3 to 5% within 24 hours, with Bitcoin leading that move. That volatility premium is already being priced into options markets. Employment data is where things get messy. January non-farm payrolls added roughly 130,000 jobs, crushing expectations of 66,000. Unemployment held near 4.3%. That looks solid. Then February flipped the script. Job losses of approximately 92,000 positions, with unemployment ticking up to 4.4%. That whipsaw creates uncertainty about labor market momentum and whether the Fed sees enough softening to justify easing. Mixed signals like this typically push the Fed toward caution, which supports that 60% neutral hold probability. Treasury markets are already moving. On March 2nd, the 10-year yield touched an 11-month low of 3.926% before rebounding to 4.10% by midday March 3rd. The 2-year yield hit its lowest level since 2022. That yield curve compression tells you markets are anticipating policy easing, even if the exact timing remains uncertain. Fed funds futures and SOFR markets currently price in approximately 225 basis point cuts for the remainder of 2026. If the Fed signals those two cuts explicitly in the dot plot, you'll see further yield compression and potential breakouts in rate-sensitive sectors. Speaking of sectors, equity positioning matters here. The S&P 500 and NASDAQ 100 are set up for rotation based on Fed messaging. Rate-sensitive sectors, including REITs and utilities, are particularly vulnerable if the Fed stays hawkish or signals only one cut. But if we get that dovish shift to two cuts, growth stocks benefit from sustained lower rate expectations. Technology, consumer discretionary, and small caps typically outperform when the Fed pivots dovish because lower discount rates increase the present value of future earnings. That's basic valuation math, but it drives real capital flows. According to analysis from A-Invest, we're looking at three primary scenarios for the March meeting. The dovish hold scenario carries roughly 25% probability. Fed holds rates but shifts the dot plot to two cuts for 2026. That's your high volatility outcome. Equity markets would likely rally, Treasury yields compress further, and crypto sees that 3 to 5% pop. The neutral hold scenario sits at 60% probability. Fed holds rates, keeps dot plot at one cut, emphasizes data dependence without strong forward guidance. That's your base case, and it likely keeps current market positioning intact without major repricing. The remaining 15% covers other outcomes, including more hawkish positioning or even an actual rate cut, though that seems unlikely given recent data stability. One critical factor complicating this decision is Chair Jerome Powell's term expiration on May 15, 2026. That's just 2 months after this meeting. Reports suggest potential nominees for succession, including Kevin Warsh, who's perceived as having a more hawkish policy orientation than Powell. This leadership transition timeline means the March meeting could be among Powell's final major policy decisions. If Powell wants to cement a dovish legacy or set the stage for his successor, this meeting is where he signals it. Markets will scrutinize every word in the statement and press conference for clues about transition dynamics. External factors are adding complexity beyond domestic data. Middle Eastern geopolitical tensions are affecting energy prices, which feed into inflation expectations. Global supply chain disruptions continue influencing pricing dynamics. Tariff policy uncertainties impact trade flows and corporate cost structures. The Fed doesn't control these variables, but they shape the policy backdrop. If oil prices spike due to geopolitical escalation, that inflation concern could keep the Fed cautious even if domestic data supports easing. Let's talk fixed income positioning, short and intermediate maturity. Treasury securities show heightened sensitivity to rate cut expectations right now. If you're trading bonds, the 2-year to 5-year part of the curve is where the action is. A dovish shift pushes yields lower and prices higher on those maturities. The 10-year has already moved significantly, touching that 11-month low, so further downside may be limited unless the Fed signals aggressive easing beyond 2 cuts. According to Thrivent Fund's March market update, bond markets are wobbling stocks with stronger performance as rate cut expectations build. That relative strength in fixed income versus equities is a key risk-off signal. Crypto traders are watching this meeting closely. Bitcoin and Ethereum are highly sensitive to liquidity conditions and risk appetite changes. Lower rates mean easier financial conditions, which historically correlate with crypto rallies. That 3 to 5% Bitcoin move on a dovish outcome isn't just speculation. It reflects how digital assets respond to Fed policy shifts. If the Fed disappoints and stays hawkish, expect the opposite. Crypto could sell off 2 to 3% as risk appetite contracts. Volatility is the trade here, whether you're positioning for upside or downside. Data dependencies leading into the meeting are critical. The Fed will review the latest inflation readings, employment data revisions, consumer spending patterns, and financial market conditions. Any significant shifts in those inputs during the next 5 days could alter the outcome. That's why positioning now requires flexibility. Don't over-lever into one scenario. The market is giving you roughly 60-40 odds between neutral and dovish outcomes. Size your positions accordingly. For equity traders, sector rotation is the play. If the Fed goes dovish, rotate into growth and rate-sensitive names. If they stay neutral, defensive positioning in healthcare and consumer staples makes sense. If they surprise hawkish, financials could benefit from sustained higher rates. But overall, equity markets would likely pull back. The S&P 500 is currently trading near key technical levels, and the Fed decision could determine whether we break higher or test support. One underappreciated angle is international central bank policy divergence. The European Central Bank and Bank of Japan are on different trajectories than the Fed. If the Fed cuts while other central banks hold or tighten, that impacts currency markets and cross-border capital flows. A dovish Fed typically weakens the dollar, which benefits commodities priced in dollars and emerging market assets. Gold, oil, and emerging market equities could see inflows if the Fed signals easing. The dot plot itself deserves attention. This visual representation of individual FOMC members' rate projections shapes market expectations for the entire year. Currently, the median shows 1 cut for 2026. If that median shifts to 2 cuts, it's not just about 25 basis points. It's about the Fed's assessment of economic trajectory. 2 cuts signal concerns about growth softening or confidence that inflation is contained. 1 cut suggests caution and data dependence. The difference between those scenarios drives hundreds of billions in capital allocation decisions. Looking at credit markets, corporate bond spreads have tightened in anticipation of easier policy. Investment-grade and high-yield spreads are near multi-month lows. If the Fed delivers dovish messaging, that tightening continues and companies benefit from lower borrowing costs. If the Fed disappoints, spreads could widen as recession concerns resurface. Credit market stress is always a leading indicator for equity volatility, so watch investment-grade and high-yield spreads closely after the meeting. 5 days is a short window, but positioning now determines how you capture or avoid the volatility coming from this decision. The convergence of economic data, market positioning, and policy transition dynamics creates both risk and opportunity. According to analysis from GeoMarkets on U.S. market drivers for March 2026, this FOMC meeting is the single most important catalyst for the month. Everything else, earnings reports, geopolitical developments, economic data, gets filtered through the lens of Fed policy. Final consideration. Forward guidance matters as much as the decision itself. Powell's press conference language will shape how markets interpret the dot plot and rate decision. Hawkish holds can become dovish if Powell signals high confidence in future cuts. Dovish holds can turn neutral if Powell emphasizes uncertainty and data dependence. Listen for language around inflation trajectory, labor market assessment, and financial stability concerns. Those phrases telegraph future policy moves and drive positioning for the next quarter. That wraps your market intel. Trade smart out there. For deeper insights and real-time analysis, visit capitalcopilot.io.